$1.22. That is how much OpenAI loses for every single dollar of revenue it earns. And on Friday afternoon at 3:47 p.m. Eastern, that exact number landed inside a confidential S-1 prospectus targeting a $1 trillion valuation. By the closing bell that same day, more than $130 billion in Nvidia market cap had quietly evaporated. By the end of this video, you will see why those two numbers together broke Wall Street's spell. Picture the trading desks at Goldman Sachs and Morgan Stanley around 4 p.m. Eastern Time. Every screen glowing red. Every Slack channel exploding. Nvidia had just posted the cleanest earnings beat in semiconductor history, $81.6 billion in a single quarter, up 85% year over year. Jensen Huang told analysts that demand had, quote, gone parabolic. The stock fell anyway, down nearly 2% into the close. Even on the cleanest possible print. Closing price, $215.33. That is the fourth consecutive quarter where Nvidia has crushed estimates and the stock has dropped 4 times in a row. If that does not make the hair on your arm stand up, you have not been watching this market closely enough. Because somewhere between Thursday's close and Friday's bell, the most expensive stock in the entire AI complex stopped responding to good news. What unfolded over the next 24 hours was not a normal pullback. It was the precise moment institutional money started asking the question they had been avoiding for 2 years straight. If the single best earnings report in chip history cannot move this stock upward, what on earth happens the first time the report finally disappoints? Every analyst on Wall Street wrote variations of that exact line into Friday night client notes. Rewind 2 days. Nvidia walked into Wednesday's earnings call as the most watched company on the planet. Shares had climbed roughly 20% off the February lows. Just 8 days earlier, on May 14th, the stock had hit an all-time closing high of $235.74. Strategists were calling it the calmest, most confident AI tape in months. Volatility was crushed. Options skew was flat. Everyone leaned in. The numbers, when they hit, were genuinely historic. Data center revenue alone, $75.2 billion in one quarter, up 92% year over year. Next quarter guidance, $91 billion, nearly $4 billion above the FactSet consensus. Management then stapled an additional $80 billion share buyback on top, and raised the dividend 25-fold to 25 cents a quarter. Any analyst playing word association would have shouted, "This is a melt-up print." Read those numbers one more time. $80 billion in fresh buybacks. A 25 times dividend hike in a single keystroke. Demand growing at roughly a 90% annual clip on a base of $75 billion. By any rational measure, that is the most aggressive shareholder return announcement in the entire history of the semiconductor industry. There has never been anything quite like it. Not at Intel in 1999. Not at Cisco. Not even close. And yet, the market took one look at the print and started selling. Not panic selling, something quieter, more unsettling. Big institutional desks trimmed positions through Thursday morning. Hedge funds rotated. Quants reduced gross. By the closing bell on Friday, more than $130 billion in Nvidia market capitalization had quietly, methodically evaporated. No headline. No catalyst. Just relentless, polite, mechanical selling from the smartest pools of money in the world. This is supposed to be the calm part of the story. On paper, everything still looks invincible. Hyperscaler capital expenditure for 2026 is now running above $700 billion. Artificial intelligence is currently absorbing 87% of every venture capital dollar deployed in America. The boom has never looked bigger from the outside. So why exactly was the smartest money in the world already, quietly, walking toward the exits? At 3:47 p.m. Eastern on Friday afternoon, the answer arrived. OpenAI confidentially filed its S-1 IPO prospectus with the Securities and Exchange Commission. Goldman Sachs and Morgan Stanley listed as joint lead underwriters. Target valuation, between $852 billion and $1 full trillion. The largest technology initial public offering ever attempted, by a margin so wide it does not even have a close historical comparison anywhere on record. Here is the line that froze every fund manager from Greenwich to San Francisco. According to people familiar with the filing, OpenAI is losing $1.22 for every single dollar of revenue it brings in. Read that again. They are generating roughly $2 billion a month, and burning more cash than they earn doing it. $1 trillion valuation math. With 50 million consumer subscribers footing the bill, but it gets worse. The S-1 lands directly into Nasdaq's new fast entry rule, which only went live on May 1st. Under the old system, a freshly listed company waited up to 1 full year before joining the Nasdaq 100. Under the new system, Qualifying mega IPOs are inducted after just 15 trading days, roughly 3 calendar weeks. The rule was written almost surgically for exactly this moment in market history. Translation: the second OpenAI lists this fall, every index fund on planet Earth is forced to buy it, which means they are forced to sell something else to make room. SpaceX, which filed its own S-1 on May 20th targeting a $1.75 to $2 trillion valuation, lands inside the exact same rule. Anthropic, eyeing a $900 billion listing in October, lands in the same rule. 3 blockbusters, 1 pipeline, 1 forced rebalancing, 3 of the largest IPOs in human financial history, all routing through one accelerated index pipeline, all forcing trillions of dollars in passive money to dump existing tech leaders to make room. That, more than any single earnings number, is what made the Friday tape feel structurally different. The math behind every 401k and ETF in America is about to be rewritten, and it will not be rewritten in Nvidia's favor. Inside Apollo Global Management, economist Torsten Slok ran the latest concentration figures. 87% of venture funding now sits inside artificial intelligence. 38% of all high-yield bond issuance is linked to AI projects. 49% of investment-grade debt issuance. In 1999, at the absolute peak of the dot-com mania, internet companies took less than 40% of venture money. We are now more than double that historical peak, and here is where it gets really uncomfortable. The Shiller cyclically adjusted price-to-earnings ratio on the S&P 500 just crossed 40. That is the single highest reading recorded since the year 2000, right before the dot-com crash erased roughly 80% of the Nasdaq's value over 3 years. Michael Burry, the same investor who shorted the housing market in 2008, told his subscribers this month that AI is, quote, in its final, irrational stage. By Friday's close, the cracks were visible from orbit. Nvidia down. Enterprise software, under pressure for the 3rd straight week. The broader Nasdaq, which had brushed 26,000 earlier in May, suddenly stalling out. Kevin Warsh was being sworn in as the new Federal Reserve Chairman that very morning. Iran ceasefire talks were flickering toward a resolution. Oil was easing. None of those macro tailwinds mattered. Tech kept bleeding regardless. Every conversation on every trading desk in Manhattan was the exact same shape. If OpenAI's filing forces tens of billions of dollars of mechanical selling out of Nvidia, Microsoft, Apple and Meta to fund index entry this fall, and if AI's largest private name is losing more than $1 for every dollar it earns, what precisely is holding the rest of this rally together? Nobody had a clean answer that Friday. That is the question every portfolio manager woke up to on Saturday morning. There is no obvious next bid. The retail crowd is already maximally long every AI name they can spell. The institutions are stretched. The hedge funds are net long at multi-year highs. The next marginal buyer of these stocks, for the first time in roughly 2.5 years, is genuinely, unsettlingly unclear. The narrative engine has stalled. None of this means the AI story is over. Nvidia's demand is real. OpenAI's user base is genuinely enormous, 50 million consumers, 9 million businesses. SpaceX is still the most valuable private company in human history. The underlying technology is not going to unwind anytime soon. But the valuation arithmetic? The reflexive any price is justified assumption of the last 2 trading years? That part stopped breathing on Friday afternoon, and may not start again the same way. Now you can see exactly what that single document was, OpenAI's confidential S-1 prospectus, and the single number inside it that broke the spell. $1.22 of losses for every single dollar of revenue. At a $1 trillion valuation. Routed through a brand new fast entry rule that forces every passive fund on the planet to buy it. That is the precise 24-hour trade that made the AI giants stop breathing. Tell me in the comments, are you buying this dip, or are you the smart money walking quietly toward the exit? Hope you got something out of this. Hit subscribe for more in this lane, and we'll see you in the next one.